2021 has been a decent year for the stock market, but we have seen pretty frequent small pullbacks from time to time. And I think that with stocks being valued as highly as they are, we'll continue to see these types of pullbacks throughout the year. So to ensure that I'm always bringing in significant premium, regardless of market conditions, I like to throw in some additional strategies alongside my usual covered call writing. So in this video, I'm going to talk about those strategies and show you exactly how I'm applying them in the market today. My name is Charlie, and on this channel I make videos about building wealth and achieving financial freedom so that you can free up your time to focus on the things that you truly care about. So for those of you that have been watching the channel for a while, you probably already know what strategies I was talking about at the beginning of this video. But for those of you that don't, I'm talking about selling naked calls and or setting up bear call spreads. But I set them up in a very specific way, which allows me to profit regardless of market direction. And I've talked about this in detail in a couple of previous videos, so I'd recommend that you check those out first for some more background if you haven't seen them yet. But the gist of it is that I'll sell a naked call just a few weeks out and about $7 to $20 out of the money, depending on the price of the stock and how volatile it is. Then I'll set up an automatic buy order to purchase 100 shares of the stock, only if the share price approaches the strike price of my naked call. That way I collect a premium for initially selling the naked call, and if the stock price doesn't rise, then the call expires worthless and I never have to buy any shares. But if the share price does rise to above the strike price of my call, I'll have already bought the shares due to my automatic buy order, so I'm basically just left with a covered call at that point. So with that background out of the way, let's talk about the recent trades that I've made so that you can see exactly how I'm setting these up right now. So in general, I prefer to use this strategy on stocks that I like for the long term, but then I'm slightly bearish or neutral on in the short term. And specifically right now, my favorite stocks to use it on are slightly cheaper, more volatile stocks, because I found that if I set up my naked calls properly on stocks like that, I can bring in pretty significant premiums without locking up too much of my buying power. So the trades I've made this week have been on AMD, CHWY, and Pinterest, which are all stocks that I like for the long term, and they have great consistently increasing revenue, but for whatever reason, the market hasn't wanted to push their prices higher. So in the meantime, I've been selling naked calls to collect additional premium as I wait for them to recover. So we'll start with my trade on CHWY, and at the time I set it up, the stock was trading at about $81.90. So what I did was sell the August 6th 90 strike call, which is about $8 out of the money and 2.5 weeks out in time. So for selling that call, I brought in a premium of $125. Then at the same time, I also bought 10 shares of CHWY at the current market price, which is something I often like to do when I set up these trades because it allows me to benefit a little bit more if the stock does end up rising. Then I set up my automatic buy order to buy the remaining 90 shares if the stock price hits $89.50. So this is a pretty typical naked call that I might sell because it's on a stock like CHWY that's somewhat volatile, so I could bring in a pretty good premium, but I also sold the call far enough out of the money and close enough in time that it's not likely that CHWY is going to hit my strike price by the expiration date. So most likely I'll collect this premium without ever having to buy any shares, but if the stock does end up rising, I'll be covered by that automatic buy order and I'll still come out with a pretty decent profit on this trade. So again, CHWY is a stock with pretty good fundamentals with consistent increasing revenue on a quarterly basis, and I think with online sales becoming more and more prevalent, this stock is going to do very well in the long term. But looking at the 6-month chart, it's not quite so strong, so the trend isn't really in the stock's favor right now, and that's the reason that I'm slightly neutral to bearish on it in the short term. So the next trade I made was on Pinterest, and at the time the stock was trading at about $70.70. So in this case, I sold the August 6th 80 strike call, which is a little over $9 out of the money, and again expires in about 2.5 weeks. So in this case, Pinterest does actually have an earnings announcement before this call expires on July 29th. So it's a slightly riskier trade, but there are a few things that I did here to sort of mitigate that risk. For one thing, I bought 25 shares on the side instead of just 10 as I did with CHWY, so that if the stock does make a big move after the earnings announcement, my cost basis will be a little bit lower. Then I'll set my automatic buy order to buy 75 shares if they rise to $79.50 per share. Then the other thing I did was just sell my call a little bit further out of the money. So even though I'm setting this trade up around an earnings announcement, in general I prefer not to do that. And the reason is that stocks can often make big after hours jumps following a positive earnings announcement. So if that does happen and the stock jumps past the price of your automatic buy order, that order won't get executed until the next trading day. So you could end up buying the stock at a higher price than you initially intended. And that situation is really the only way that you can lose money on this trade. But as you can imagine, that's a pretty rare rare scenario. And by selling the call a bit further out of the money as I've described, and buying at least 20 shares up front, you can significantly mitigate that risk. Now the next trade that I made this week was on AMD, and at the time AMD was trading at about $85.50 per share. So what I did here was sell the 95 strike call that expires on August 13th. So that was about $10 out of the money and about 3.5 weeks out in time. The reason I was okay with selling it a bit further out in time is because it allows me to bring in a bigger premium, and I already have quite a few shares of AMD on the side, plus a leaps option that I'm holding. So if the stock does rise, I'll still have plenty of upside. But AMD is also another stock that has an upcoming earnings announcement, in this case on July 27th. So again, in general, I prefer not to sell my naked calls around earnings announcements, but right now in the market, we are approaching the heart of earnings season, so it was hard to find stocks that were good candidates for this trade that didn't have an upcoming earnings announcement. Plus, doing it this way does have the advantage of providing higher premiums due to the extra volatility around earnings, so if you're okay with the extra risk, you may not mind setting it up this way. But anyways, in this case, I set up my buy order to purchase 80 shares if they rise to $94.50. So all in all, these 3 trades will lock up about $26,500 worth of buying power. But the beauty is that that's not capital that I have to take away from my other trades, because I have available margin that I can use to cover the shares if I do end up needing to buy them. And since I haven't actually bought the shares yet, I don't have to pay any margin interest on them, so that's just one of the many advantages of having available margin at your disposal, which I actually discussed in more detail in my most recent video, so if you haven't seen that yet, I'd recommend that you check it out in the bottom right corner of the screen. Thanks for watching, and I'll talk to you all in that next video.